Hello, everyone. Welcome. You have Akshay and Deepak here from Shining Star Funding, and today we have Wendy Barnett, account manager from Arch MI, here with us, and she's going to be discussing appraisal gap strategy using mortgage insurance. Wendy, you want to go ahead and take it away?
Thank you so much for the introduction, and I'm very excited to have the chance to be talking to all of you today. I'm Wendy Barnett with Arch Mortgage Insurance, and we have some very interesting things to be talking about today in regards to what to do with the appraisal gap with offers that your borrowers are making on homes, and then the appraisal comes in lower than the actual sales price. So what we're going to talk to you about right now is, in today's low inventory seller's market, properties for sale are often receiving multiple offers, and you are seeing that every single day. I'm going to be using an example that may or may not fit your market, but it's just nice round numbers, and it makes it so you can kind of see everything in a snapshot. So after making several offers on homes, your borrowers finally win the bid for the home at $420, but then the house appraises at $380. How much extra cash out of pocket will your borrowers need to bring to the closing table? $40,000, $24,000, $8,000, or some other number? I'd like to show you that even though it's a seller's market and many contract offers are containing escalation clauses, and lenders are often presented with contracts reflecting purchase prices as well over the list price, we have a way of helping you in these scenarios. So the appraisal gap is what I just mentioned. The purchase price was $420 and the appraised value was $380, and that's called an appraisal gap. If your borrower has come to you, and as most borrowers are in this day and age, they're actually coming in with 20% down. Only about 5 to 7% of all mortgages are done with private mortgage insurance. And so we know that many real estate agents and loan officers are not really familiar with how you can use mortgage insurance to help your borrower that's got $100,000 in funds to close and on this purchase price that we're looking at. And you're going to, of course, have your own scenarios as time goes on. In the scenario here, I just want to introduce you to single premium mortgage insurance. In the left-hand column, we've got our 20% down scenario. In the middle column, we've got a $20,000 appraisal gap. And in the right-hand column, we have that $40,000 appraisal gap that we discussed earlier. You can see here that instead of bringing in $40,000, in this case, the mortgage insurance one-time premium not added to the monthly payment is $25.5120. Thus, their closing costs will now go up by that $25.5120. So they've got their cash to close of $100,000. Their LTV has now gone from 80 to 88, but their interest rate and their loan term and their monthly payment has not changed at all. And this is using single premium mortgage insurance. If you wanted to finance that mortgage insurance into the mortgage, you would no longer have that at closing. You instead would have a LTV of 89% and a loan amount of $338,251, with their monthly payment now going up by $10 to $2,032. So I'm just going to rest here right now and just let this kind of sink in. I'm going to that right-hand column because that's very realistic of a price difference of $40,000, and I've had some as high as $100,000 or more, and even in the $800,000 range, and it still works very nicely in these scenarios. So as I mentioned, you can either pay it all up front, that $2251.20, or you can add it into your loan amount. So instead of being $336, we are now $338,251, which takes their monthly payment up just slightly. So once again, they've no longer had to come in with $40,000. They now have a bump in their monthly payment of $10. I really love the financed MI. One thing to remember too, and as real estate agents, you may not be quite as familiar with this, but a loan that is above 80% will many times have a better rate or points and fees than one that is at 80% across the board. The reason is, with mortgage insurance, your investor feels a little bit safer, so they will sometimes give a better price at an 84% or an 88% LTV loan instead of an 80%. And in this example, we're going to use that middle column, that $20,000 difference, and see that we've got 25 bips to pay towards the single premium, which is an extra $840 in this case. So when we look at that one, we always have our 20% down example on the left-hand side, but on the right-hand side, we are now at 84% LTV. We've got mortgage insurance of $1,377.60, and you use that $840 towards the $1,377, so that your closing cost, your cash to close, is now $93,178, still within that $100,000 max that your borrower has, and the payment did not change again. That $20.22.20 is still the monthly payment. I really like this scenario as well. It just gives you a good feel of how you can use those points and fees towards your mortgage insurance and how it's going to make a much bigger difference in your borrower's scenario than if they were to put more money down. So one of the last ones I want to show you from an appraisal gap strategy is monthly mortgage insurance. In this example, we've got that $20,000 gap. We've got now an 84% loan, and your MI cost is $40 a month. But if you use that $840, you can use it either towards your cash to close, or in this next example, you can actually put it towards your mortgage insurance. So if you look at that right-hand column, instead of $40 a month, now it's $23.33 a month for your monthly MI. So your borrower's payment has gone up by $23.33. They're still coming in with that original cash to close of $92,640, and now their LTV is just 84 instead of being an 80% loan. I like this scenario as well. We do a lot. Most mortgage insurance is done on a monthly basis, and Arch is the only MI company that has what's called the buy-down. Many of our competitors have what's called split premium, where you put a little bit up front, and then you still have a monthly premium, like I'm showing you here. But with Arch, you can use any dollar amount. It's not a set dollar amount like our competitors have. So if you've got a little bit of seller contribution left, you've got a builder contribution left, or that monthly payment needs to be lowered just slightly, you can buy that mortgage insurance down to accomplish that goal for your borrower. This is a really small chart, and I gave this to Deepak to give out to you because I like it because it shows all four scenarios side by side. It's got your original 20% down. It has what changed in yellow if you've got the gap with single premium, with single finance premium, and with monthly premium. I did not add in that points and fees discount here because that varies so much. I felt that Deepak is going to be the best person to come to talk about what's best for your borrower and in these different scenarios. And what Deepak does when he's actually pre-qualifying a borrower is he knows how much they can qualify for. So he knows that the max that this borrower can qualify for is maybe $340,000. That monthly payment, that's the max that they can go to. But he also knows that instead of putting that whole amount down for a 20% down or more, it's really nice to keep some cash back in your pocket so that you as a borrower or you as a new homeowner can do things to the property that maybe if you're cash strapped, it's not going to be as easy to do, or you're going to put it on a credit card instead of using this wonderful 3.25% interest rate. You are going to have a much higher interest rate if you're buying curtains or putting in a new lawn or a backyard or a pool. So anyway, I like this scenario, and Deepak has this for all of you, and that you can look back at as just a refresher. So when we talk about our borrowers, though, we really want to be proactive, and that's what Deepak does. He helps them be not reactive. So when your borrower is going out and they know that they can qualify for, let's say we said that the $340,000 loan amount or $380,000 loan amount, that they know they can offer up to X amount for whatever home that they're going for, to cover even this appraisal gap. So they can be the most aggressive, but also comfortable with their payment, their closing costs, their interest rate, etc. So this is what Deepak does, is he goes across the board and gives them all the samples. So when they're going out with you as their realtor, they are confident in what they can offer and how they can win the bid instead of being second or third in line, which we all know happens every day. I talked to a very seasoned veteran recently that said she lost a home over a $7,000 difference between her offer and the one that was accepted. And she's just kicking herself because she could picture herself in that house. And that $7,000 would not have made a difference at all, basically, in the payment. And Deepak can show that to your borrowers. So this also makes it so it's not necessarily always about the interest rate. It's about the whole strategy that the borrower is doing. So in this case, we really proactively talk about the appraisal process. We educate the borrowers about the appraisal value and waivers and partial appraisal contingencies. And we include partial appraisal contingencies in our contracts as part of our overall strategy. And from a realtor point of view, you're having proactive conversations about the inventory crisis with your borrowers and reinforcing the message that they're getting from Deepak as their realtors. And his job is to train the realtor, his clients, on how to write offers using this strategy to help his clients make more aggressive offers and utilizing the partial appraisal contingency waivers. One thing, and this is more for Deepak than any of you, is contacting your realtors on Mondays and finding out if they had any borrowers that lost the home because they didn't participate in this kind of a strategy with their loan officers. So those check-ins with the realtors, they may have some folks that with Deepak's wide knowledge and ability to use this strategy, it's going to be in his best interest and yours that this takes place. So anyway, to really recap, it's real, folks. We're in a seller's market. It continues to be that. I was just mentioning to Anjay and Deepak that we made an offer $15,000 over recently on a condo. It was at $445 and it went for $590 cash. So face it, luckily we were not emotionally attached. It was going to be an investment property, but let me tell you, if it had been the home of my dreams, I would have been pretty doggone sad. That was such a huge difference. So anyway, being proactive, Deepak is doing this right now by asking for time at your sales meetings as well as being here online with you, and then contacting listing agents when they receive a contract from your borrower while offers are coming in, and let them know your borrower has a plan. It strengthens your borrower's offer. And this is all I have to talk about from this perspective, Deepak. Is there any questions that anyone in the group or you have in regards to what I was talking about?
Are you able to hear me?
Yes, I can.
Okay. So the question was, can you give give them an idea of what that MI factor is, what that payment is on a 85% loan. So let's assume someone's making an offer for 80%, but the appraisal comes in
Mhm.
less. So now our next number is going to be the 5%, up to a 5% gap. So let's see an MI factor at 85% for a great FICO score borrower, maybe a 760 FICO borrower,
Mhm.
85% at a on a high balance loan, maybe 800,000 or so.
Mhm.
Can you give them an idea so we can tell them what that payment would change by?
Sure. And what I'm going to do here is I'm going to stop sharing for a moment and then go back to my laptop here, and I can open up. I'm going to share. Let me get into here, RateStar. I'm going to go into our RateStar portal. I'm going to show you how this works, and I'll show you in 1 second here. Just want to make sure I'm in the right place. So I'm going to reshare, and anyone can go in and look at
Exactly.
this information. So
Mhm.
here we go. Share. Okay, can you see my ArchMI now?
Uh, Now they can.
Okay, great. I'm just going to say, I'm going to actually go, let's say, recent quotes, see if I can find a quote. Okay, so in this case, I have a gap example at 90%, and actually I'm going to make that down to, you wanted it to be 85, and so I'm going to make this at 85. It's an 822,375. Is that a good loan amount?
Yeah.
We've got a purchase, we've got 720, we've got a 25/44 ratios. So, you know, pretty logical borrower. This one is going to be borrower paid single is 4194.11. Do you see that, Deepak?
Yes, but I tend to push them on the easy monthly, which is just
The
$102.
102.80. Yeah.
Just $102.
Yep.
So if the appraisal came in less, they don't have to bring in that extra money. All they need to do is bump up the monthly payment by that 102 extra dollars. And of course, the realtors are always telling the borrowers about the appreciation that's going to happen in the next 1 year. So they're always comparing those parts uh, compared to what they are spending now.
Correct. And then what we bring in here, Deepak, is if that 4194 was added to the loan amount, because remember, we go off of the base loan amount. If you added the 4194, would that change their payment less than the 102.80? That's where that nice side-by-side comparison that we're talking about works
Absolutely,
if you were to
absolutely.
finance it in.
Yes,
Yeah.
absolutely correct. Adding the 4194, if they just bring that cash in, there'll be no payment change.
No payment change if they bring the cash in, and if they finance it in, I doubt that that 4194 is going to bring it up 102.80 a month. So it really, I like that side-by-side comparison here. And here, remember, we are looking at a loan amount of over $800,000, and we're talking about a borrower with two borrowers, 720 FICO, but we also had a 44 back-end ratio on this example that we just did. So we're not looking at an unattainable borrower in this situation.
Right.
Yeah.
A $4,000
So that
should change it by roughly, I would say, about $20. The payment would change by $20.
so you can see where this side-by-side comparison that I gave you, Deepak, is
Mhm.
like my favorite thing to do, is so I can see what really makes a difference for that borrower in this scenario.
Sure.
And with ARCH, you can actually run scenarios side by side. So we did that example. If we wanted to make this an 87, what is that going to do we can run that scenario. It's going to come up with it, all the information. So I really appreciate that. It really jumped up once above 85. Now it's $200 a month and $93 for that upfront premium. So you really do look at, what's going to be best for your borrower. For this borrower, 85 is good. If we get to 87, if we went to 90, it's still going to be the same though. So it's not going to change this scenario.
Yes.
So anyway, I hope that's helpful.
It is. It's absolutely helpful. In fact, the financing the MI is. I haven't explored it too much in detail. Maybe I should start looking at financing the MI also. Just been offering the normal monthly MI option.
Well, here's your examples, and you know me, Deepak. I'm always here to help and run these scenarios with you. Happy to help anytime, and anyone can access our website and run scenarios. So anyone in your team.
Sure. Akshay, do you have any questions?
Nope, no questions here. Wendy, what was the website, and I can just put it in down here right now.
Archmi.com.
It's archmi.com. ARCHMI.com.
And then they go to RateStar. And you want to, let me get.
Yeah, I'll show them what that looks like. So this is what it's going to look like.
So someone who does not have an NMLS ID, what do they add in there? Nothing?
No, what they'll do is we can actually, any NMLS number will work, but also you can get approved just with your email. So request access, and they'll send it off to you.
Yeah. That is.
Well, once again, thank you.
Thank you so much.
I appreciate it.
Thank you so much. Appreciate it. Look forward to talking to you again. Thank you.
Thanks so much, Wendy.
Thanks for your great business.
Thanks.
Bye.
Bye-bye.